everyone, I'm Nova Lui, Head of Investors Advisory at RHB Bank. Welcome to our Money Chat. Today, we are fortunate to have 4 esteemed speakers discussing the factors behind the fluctuation in global equity market. We will mainly focus on discussing a few markets which have seen material volatility in 2024, which includes US, especially technology sector, China, India, and Japan. Our first speaker is Ms. Rasid, Vice President of JP Morgan Global Market Strategies based in Singapore. Raisah is responsible for delivering the latest market and economic view on JP Morgan's Global Market Insight strategy. She will be sharing with us on her view on US and global equity market. Hi Raisah, thank you for joining us today.
Thanks very much, Nova. Happy to be here.
US equity market, including Nasdaq, have done well this year, despite some volatility, including the dip in July. Both S&P 500 and Nasdaq likely to end the year with return close to 30%. Would you think that US government policy will influence the prospect of large US technology company, and would it be for better or for worse?
It could mean relatively less regulation, so less focus on energy and banks and more accommodation to tech companies. So initially, we had thought that there would be a continuation of antitrust enforcement on some of these big tech companies. But what we're seeing in the last couple of days or weeks is an increased prospect of deregulatory measures that could really support big tech. But just note that the CHIPS Act that was passed in 2022 was also very instrumental in the capital expenditure expansion that we've seen in the US right now. And you can see in the chart in front of you, we have seen that corporate America is really spending now. Part of it is due to AI, automation, but the other part is also about re-onshoring. That's really bringing back some of that manufacturing facilities back into the US as well. So we do think that there is scope for a leg up in the technology space. And we think that this is really part of the focus of national security interests. And so this really has allowed some of the tech companies to operate almost like what we call tolerated monopolies. And this is a phrase that we actually use in our latest long-term capital market assumption piece. And it's a situation where, despite growing scrutiny from legislators, we do think that this will continue for a long time from now. So ultimately, we think that the widespread potential of AI really reinforces the US large tech sector dominance. But one thing to really stress here is that there are other sectors that's really attached to AI complex that would also be beneficiaries from this dominance.
All right. Based on the current valuation, it seems like the large technology companies' future cash flow are overpriced by investors. What do you think?
Yeah, I think to your point, you can see in front of you the chart that really shows that the current valuations of the tech sector is really sitting at the top end of the historical average. So effectively, it is screening expensive now. Are this justified? It's not a straightforward answer. A lot of capital expenditure has been poured into tech, but do they justify the long-term growth potential? Only time will tell. With every transformational shift that we're seeing, whether is it the invention of computers or the advent of motor vehicles, the impact on the economy, whether through labor productivity growth, it does not happen immediately. Again, we are long-term investors, and this is why we think that the long-term growth potential from AI, from tech, is there. And this is really very consistent with a constructive earnings growth backdrop that we see in 2024 and 2025 for technology, which you can see on the chart as well. Now, what we tell our investors is to stress on the fundamentals of the economy rather than looking at specific sectors as well. So I think that's number one. And number two, if you just take a step back and think about the equity market leadership, if you just focus on the top 10 slides, for example, what you're going to see is that we are going to see an expansion of that leadership going away from that top 10 stocks. So these are more of your technology stocks to the broader remaining 490 stocks in the S&P. And that's really underpinned by an earnings recovery that we are seeing going underway right now. And that's a very important point to be made here.
Within the technology sector, there is a lot of hype about generative AI. Would the prospect of global artificial intelligence hype would wane in an interest rate cut cycle?
So the short answer to your question is no. We do think that capital expenditure of the major AI hyperscalers will continue, as you can see on the top, the chart on the left. Even our own equities team, for example, they think the next couple of years could see investment in this area totaling close to $1 trillion US. But just going back to your question on the global AI hype in an interest rate cycle. So what you can see on the chart in front of you is really US equity returns following the start of the rate cut cycles across several episodes. Now, what we have found is that effectively during rate cutting cycle, we are seeing that technology sector does do well typically, especially in soft lending. Again, soft lending scenario is a baseline case when it comes to the US economy. But just moving away from looking at a particular sector, but moving more and broadening out to a growth style, what we're seeing more evidently right now is that the large cap growth returns during those periods of soft lending is consistently higher than compared to just investing towards just technology, which evidently sits within that growth complex. And again, we keep mentioning look back at fundamentals. What about corporate spending of some of the other growth-oriented companies beyond tech? So, what you can see in the next slide on the corporate cash available that can be deployed towards spending, such as R&D, research development. You can see that healthcare, for example, a lot of R&D has been poured into that sector. And this is really about medical precision, etc. And again, this underscores our view that we might finally get that rotation of earnings that we've been waiting for away from the large names and towards the remaining stocks that have lagged behind in the past couple of quarters.
Since beginning of the year, there has been a lot of discussion about broadening market rally. Will the sector of market broadening reduce the fund flow to the US big tech companies?
Yeah, no, I think that's a great question. I think that is a question that's on investors' mind as well. So the market broadening that we're seeing from the large names to the remaining of the stocks in the indices really underscore that theme that we're talking about, right? Secular theme. We're thinking that the long-term investors should really participate in that. That's not only has to do with tech, but really beyond. And beyond means including about data centers, because, for example, when you're using large language models, etc., that really requires a lot of electricity. So the importance of utility companies, that kind of power infrastructure that can really fuel this secular technology theme that we're talking about, really underscore that rotation, which we've been spending a couple of minutes talking about as well. But don't forget about the broader picture. If you look at the chains of events that allow some of these technologies to come, there's greater opportunity for investors to look not only at a single sector as a means of investing, but really look towards that growth style as a strategy, which typically has outperformed the technology sector, as we've spoken about during periods of rate cuts by the Fed during soft lending. So that broadening of earning growth expectation that we're talking about could really imply some shift in the fund flows over time.
Thank you so far. This is my last question. Generally speaking, do you prefer value or growth technology sector in 2025? And would you rather position fund in both sectors in view of another year of positive or potentially mild Goldilocks environment?
Yeah, great question. So first and foremost, I think us here at JP Morgan Asset Management, we do think that a diversified portfolio that contains both value and growth stocks should be top of mind when it comes to long-term investors. Now, but if we think about the environment that we are in right now, which is, we could see more Fed cuts, albeit at a more measured pace, this tends to support the growth style slightly more through cheaper funding costs at the start of that ramp up of the capital spending for some of these companies. Now, if you consider where we think that yields could settle over the next couple of quarters, it would be somewhere between maybe 3.5 to 4.5 for the US 10-year. For example, where this depends on the macro backdrop, inflation expectations, etc. And what you realize is that the annualized returns for both growth as well as value, they don't really materially differ. There is a slight edge for growth returns if yields are actually in the lower bound of that range that I've given. But again, to answer your question, we maintain that long-term investors should maintain their portfolio in both, but we do have a bias slightly for the growth stocks in that diversified portfolio. Now, the reason being is that this secular trend that we spent a couple of minutes talking about should stand to benefit from that macro environment, which is strong. That's going to translate to nominal earning growth for some of these companies, the potential for less regulation on tech coming from the change in administration, the spillover for some of the other beneficiary sectors, utilities, industrials, and more importantly, on a more secular argument, maintaining that technological advantage is a national strategic priority. So if I can just leave you with a couple of points, I think number one is stay focused on macro fundamentals. We do get a lot of noise from political speeches, campaign promises, but the implications of that policies and the likelihood of that being passed to us is more important. Number two, tech will be a dominant story, but remember to capture the opportunities that will come through from tech towards other growth-oriented sectors as well that will benefit from the easing and rate cutting cycle. And really, finally, the last point, staying diversified is still really important. So having a mix of both growth and value stocks will be very important for investors.
Thank you very much for your sharing, Raisah. Let's move on to our next speaker, who is not new in RHB's Money Chat, Mr. Raymond Jing, Portfolio Manager at China AMC, joining us all the way from China. Welcome, Raymond. Good to see you again.
Hi, Noah. Nice to meet you again.
Overall, Chinese equity market has done really well this year. Notably, most of the gains are attributed to the gain in the small window rally around end September to early October. However, the excitement was short-lived as the market then came off and remained relatively flat thereafter the Golden Week holiday. Investors are relooking into the renewed stimulus measure by PBOC and also the central government. Question is, how sustainable in terms of the rally in the equity market performance? And would China still meet this 5% GDP growth target?
Yeah, so actually, China market actually rebound since the last September, led by the changes of China policies. Okay, before that, China's market did not well from the beginning of this year, but since September the 24th or 25th till now, that most of the market, like onshore market as well as offshore market, rebound nearly 20%. So that makes the China market become one of the best performing market from the beginning of this year. And actually, we believe that when it goes into October, we saw the market become more, stabilized. And that's because the investors, they all anticipate more policies given by Chinese government in terms of fiscal side. So from the September, conference or meeting, the PBOC and CSRC that already indicate very clearly the Chinese government has made the changes from 0 to 1 by facing deflation directly and intending to stabilize housing market, job market, and overall economy. And especially that besides the banking and monetary, like triple R card or interest rate card, as well as the some relending programs given by the PBOC to the developers in housing market, we saw that some new measures or policies issued by the PBOC in terms of the stock market. For example, they set up the new, swap facilities to help the institutional investors to gain very low cost of funds to do share buybacks and invest in A share market, and also introduce some new, tools to give it by the PBOC to the listed companies, to especially the holding parties of listed companies to do the share buybacks. That all very new to China equity market, and it's pretty sure that is a very good sign for the money inflows in terms of the fund flow. And of course, when we goes to the November, actually, all eyes are on the MPC, right? A very important meeting. And through that, we do have some, good signs or good news on the fiscal policies. For example, that China, issue or give like 10 trillion RMB to local government, that's swap program. And according to Minister of Finance estimate, these measures in aggregate will save around like 600 billion RMB of interest payment burden for local government over 5 years. So that will help solve some of the payables and other obligation owed to corporate sectors, and subsequently supporting the business environment and private sectors. And we're pretty sure that more fiscal measures are coming. For example, in consumption areas as well as the product market areas, and policy next steps are key, very important for sustainable index upside. given fair market valuation now. And for the GDP growth target, you mentioned that China real GDP growth, I think, would meet around 5% target for this year. As the first 3 quarters, the growth of GDP of China was 4.8%. And the most recent policies indicate better performance in Q4. And we have already seen some or marginal improvement on some economy readings, such as CPI, such as the total social finance, and PMI, of course. So we believe it will be pretty sure that China will beat the around 5% target in this year. And the most important, when we look into the next year, 2025, especially the first half, because the supporting measures still on the way, okay, and a lot of more will coming up. So I think the performance of China GDP growth for the first half next year will be also good, and we're pretty sure that China government will set another 5% target for the 2025 GDP growth.
We trust potential further intensification of the US-China tension, especially in technology space, and also pressured by potential increase in tax tariff. Is China the second largest economy of the world, losing power over its global economic influences?
Yeah, as you mentioned, that tech restrictions has been fully pressed in a story in China market, we believe. And you can tell that the localization rates in tech related areas, especially the semiconductor area, soared during past few years, and that lead the equipment providers to achieve breakthroughs in most parts of supply chain. And from some figures, for example, the pre-order that photolithography machines provided several years buffer. Okay, so from the different period of earnings result by like ASML and some other global, especially the American equipment providers, and you can tell that China fabs already pre-ordered a lot of the equipment for these few years. Actually, we believe that SMIC, the largest fabs in China, and Huawei, they gradually improve their capabilities, and they all can achieve 7 nanometers and 5 nanometers capabilities. Even the quality yield not that high, but improvement I think is still on the way. Okay, so I believe that in terms of tech restrictions, we can tell that in past few years was a very major motivation for China government, especially China tech giants, to have some breakthroughs in terms of semiconductor localization. Okay, so we don't think that will give some further scares in terms of it's already a fully pressed in story in China market. And then the next one is the potential tariff. And potential tariff influence, I think, should be discussed, because we all know if the tariff be lifted to 60%, if China wants to export to US, I'm pretty sure it's a negative thing. But such kind of negative thing should be less than the scenario back into 2018 to 2019. Because according to the most recent data, the China has already diversified supply chain with the trade, rerouting and exploring new export destinations. Okay, if you look at the past few years, that the especially compared with the 2017, 2018 scenario, okay, China export to US decline for like 6%, and actually such kind of the transition of the export destination goes into Asian countries, Mexico, and other developing countries. Okay, so and also, of course, if you look at the shares of the China export to compare with the share of US imports, okay, actually such kind of data hit the peak back into 2017. It's around like 22%. Okay, but now actually it's only like 13%. So actually, if you look at the shares of U.S. imports, China's role has already been decreased a lot, like 8% or 9%. And if you look at the China's export in share of the world total export, okay, it also like increase, okay, from the 2017, it's around like 11% to now like 15%. So it means that China actually diversify its supply chains and its export destinations. So we believe that the potential tariff hike will have some kind of negative impact, but will be much less than back into 2018 to 2019. And the most important thing is China will likely scale up the fiscal and monetary stabilize to mitigate tariff impact.
China has given ample attention to its embattled properties market, but no avail. Oversupply of properties still persists in the country, while many developers are struggling to complete pre-sold unit due to shortage in the cash. In your opinion, will this detractor continue to hamper investors' confidence in 2025?
Yeah, I think the most important thing in terms of real estate market in China is the government, their attitude. Okay, because previously in last 2 or 3 years during the deleveraging process, that the Chinese government emphasized that they want the real estate market to be stable and want to the process stop going up, and also want to solve the problems of the very high leverage by those non-LCO developers. But actually, during the last 3 or 4 years, decline or crash or collapse in terms of real estate market in China. The first time since September, the Chinese government indicate they want to stabilize the real estate market, want to stop the declining trend of the housing price, and want to keep such kind of the selling price gradually go up. Okay, so that is the first time in last 3 or 4 years. And we do see a lot of the easing policies issued by the Chinese government. The most recent one is during the last 2 days, that is on November the 13th, the MONF, the Minister of Finance, actually issued policies to cut tax on property trade. And also, we saw since the triple R card and interest rate card, LPR card, during October and September, of course, we saw that October property sales in China rebound to positive on year-on-year base. So probably we will see more positive signs for that. And we are pretty sure more policies towards the real estate market are still on the way. For example, we can anticipate a special bond to buy property inventories by Chinese government. Okay. So from different parts of the China, and also from different figures issued by Chinese, Statistic Bureau, as well as those market-oriented institutions, we're pretty sure that China property market or real estate market have very big chance to stabilize and gradually to go up very marginally or very moderately in 2025. So yeah, so that is the basic case happened in China in terms of real estate market. Now, actually, I think the performance October and the November have already been the very pessimistic views held by most of the investors and economists. So that is my question, my answer for your question. Thank you.
Raymond, considering all the factors that you have shared with me, so would you prefer to invest into China mainland equity or the Hong Kong equity market? What about fixed income?
Yeah, in terms of the performance between different market in China, I think in short term, A shares will outperform H shares, means onshore stock market will outperform the offshore market. The rationale behind that is global long fund. They're still waiting for policies effect to happen. So such kind of the period will provide long-term power for H shares if the economy in China really turn around. But before that, actually, we still think the a very high liquidity will support the Asia market perform better than the offshore market. Okay, and for the fixed income market, actually, because this has been quite performing really good in past like 2 years, especially the the long maturity of China bond actually go down a lot during the past 1 or 2 years. But actually, if the economy in China began to catch up, we think we need to be cautious on the long maturity risks. Okay, and global fund actually still underway China market, by quite a lot, especially in past 2 or 3 years after the sell-off. So even the China market rally, especially equity market, rally in past 1 or 2 months, but actually most of the long funds still underway a lot. So that probably will provide the further motivations for the global funds come back to China if the policies show very good effect.
On business or earning perspective, which sector do you see high potential of outperformance in China for 2025?
Yeah, because now the market have already turned around. So in a bullish market or upside trend, we favor those high growth sectors. The first one is the AI related supply chain names, okay? Because investment opportunities can be not only in hardware but also software applications. So in this AI industry chains, we can explore a lot of very high beta names. And the second opportunities may comes from the high-end manufacturing. One specifically is the robotics industry, especially humanoid robotics, because also the rapid development of AI has brought a leap in perceptual level, and some leading players like Tesla and Huawei have led the industry to moving forward. Okay, the third opportunities may come from the accelerations of semiconductor localization in China, and as I mentioned, that Huawei have already promoted domestic semiconductor develop further. So domestic wafer fab continue to expand production and localization rate also improve. And consumption and also healthcare, we are also very optimistic in terms of the recover or turnaround of China's economy perception. Okay, so I think we can explore some opportunities within these 4 areas in 2025 that will provide excess return compared with the whole market.
Thank you so much, Raymond. Next is Rana Gupta, Senior Portfolio Manager of India Equity Specialist from Manulife Investment Management. India equity market is gaining popularity within Malaysia's investors in the recent years. Given its resilient performance, investors are also gradually increasing exposure in India while reducing exposure in China as part of the China Plus One strategy. However, with China aggressively stimulating economy, will the fund flow from India transition back to China based on the revised country rating for both countries by analysts?
China is definitely putting a floor under the growth. And as far as that is a welcome step, what has happened there, it will have very little to no impact, or if, in fact, somewhat positive impact also maybe on Indian growth fundamentals. But your question is about whether the fund flows can move away from India to China to play that growth. To that, we will say that Indian growth will actually continue irrespective of China stimulating their economy. We will also say that this will result into because of strong fundamentals, good earning growth, and domestic flows to continue in Indian stock markets. And I think noting this fundamental, the foreign investors will continue to, over the longer period of time, will continue to stay invested in Indian stock markets. I would also additionally note that there are a lot of geopolitical uncertainties, and those kind of headwinds, geopolitical headwinds, can impact larger economies like China. Whereas India, as compared to China, is relatively small, and we would expect the geopolitical headwinds, given India's relatively smaller size to China, as well as India more in the middle between US and China. I think those geopolitical concerns will also impact India much less. So I think that is also another supportive factor.
Gupta, since the valuations are quite stretched in the Indian stock market, would the country's vibrant economic prospect have overshadowed by the heavy profit taking?
The country's vibrant economic prospect, as you're alluding to, is a result of the very deliberate reform process that has happened over the last 10 years. As a result, India has today emerged as a country with lower deficits, a better public infrastructure, and the government could give the corporate incentives. Because of that, and investments taken by the corporates, the earning growth is strong. It's about in mid-teens. Moreover, the country's savings is increasing as a result of all these measures, and Indian savings cannot be exported out. So that is getting invested into financial instruments, including stock markets. So if you look at all three angles, whether it's the macro improvement of the country, corporate earnings growth, and domestic savings coming into the equity markets, all are supportive of the valuation of the Indian equity markets. And talking about valuation, it is trading at about 10% premium to the its long-term history, which we believe, noting at all the improvements, is quite justified.
Referring to the latest India's October 2024 headline inflation number, which is a CPI, has increased more than expected. Will this deter the Reserve Bank of India from normalizing interest rates soon? More importantly, what are the impact to the Indian stock market?
The question of inflation is an important one, and you are absolutely right. The inflation has gone up in October, but the inflation is going up due to transient factors like food prices. And that is a result of the unseasonal rains and the flooding that has happened in the previous months. Now the situation is normalized. In fact, the winter crop sowing numbers are quite good. As and when the winter crop arrives in Jan to March quarter next year, we expect inflation to normalize and RBI to take a more accommodative stance. So yes, it can get delayed by a few months, but it's not of a major concern for us, the rate outlook. And as far as the stock market is concerned, it's the delay in the rate cut can have an impact for 1 or 2 months, but we expect it to be a transient pressure only.
Do you think the China Plus One strategy would continue to favor India in 2025?
Sure. I think this China Plus One strategy is one of very important drivers for India's manufacturing ambitions. And we see the China Plus One happening most in the places like electronics manufacturing, as well as in the pharmaceutical space. We are seeing that US corporations are putting in significant amount of time and effort with Indian vendors to get more supplies out of India. This is a theme which has just started, and we expect it to accelerate. And in electronics, let me share a few numbers. In the last, in this calendar year, India is exporting close to $40 billion of electronics, and out of which $10 billion is going to Apple. So, US corporations like this, they are beginning to increase in sourcing in India, and we believe that the growth runway for such sourcing is very long. So we expect this trend to only continue strengthen in coming months.
Last but not least, what are the other factors that you foresee associated to the Indian stock market and this economy?
Sure, I think the economy is on a fairly strong footing. The economy is doing well. There may be some transient cyclical pressures like inflation, one of them you alluded to, but we believe this is transient and the policymakers have enough dry powder left should the need be there. On the other thing is about India is we discussed about the domestic flows are going to Indian markets. It's a large number. It's about $70 billion per year, or at about 6% of households' gross savings. This is a large amount. Now, the risk is that some of the foreign promoters or the foreign companies, they have begun to monetize their stake and take capital out of India. So we don't expect this trend to continue or strengthen further. But the risk is if it continues, in that case, India will end up exporting in savings. So that's another second risk. And last one on the list, I would like to highlight a final risk, and I will allude to the first question that you asked. that about China and India. Now, in the geopolitical scenario that we see today, if there is a rapprochement between US and China, and export comes back to China and it begins to grow at a much faster rate, I think that is one scenario where you can think about the FPIs, the foreign investors, will again reposition their holding. That does not impact Indian fundamentals, but in that circumstances, that kind of repositioning can again create another round of volatility in Indian stock markets.
We are moving on to our last speaker of the day, Mr. Yasuo Kono, Senior Product Specialist at Nikko Asset Management Asia Limited. Yasuo Kono-san, thank you for joining us on our Money Chat series today. Japan equity market has done well in the past few years. For example, it was up by almost 30% in 2023, with its relatively uptrend for the past 5 years. Asian investors have finally gained interest in Japan equity market. However, in the Q3 of 2024, global investor was shocked when Bank of Japan raised 10 basis points, which then shook the entire global market and unwind more than half of the global yen trade currency. With Bank of Japan intention to normalize interest rate in the near future, would a similar occurrence happen again in future?
The answer is we expect volatility to continue in the short term, but not as significantly as what we saw early August this year. So let me explain a little more detail how stock sell-off occurred. The BOJ raised the policy rate at the end of July. It was not a surprise, but timing did matter. The US rate hike odds increased at the same time because of the softened employment indicators. Furthermore, the BOJ governor comments at the meeting were seen as hawkish. This combination drove the investor to unwind their yen carry trade to avoid the losses from the yen appreciation driven by declining rate differential between the US and Japan. But what's different now is yen carry trades are limited. That means potential upward pressure on Japanese yen significantly reduced. And what's more, the BOJ is unlikely to raise interest rates at a rapid pace since the market experienced massive sell-off, partially because of that rate hike. So overall, the market is focused on the USD JPY rate as Japan continued to raise the interest rates while the US had started rate cuts. However, the key driver for Japan economy is domestic demand, especially a recovery in consumption is expected to support the Japan equity market over the medium term.
Japan has suffered decade-long deflation, but recent pandemic crisis helped push prices back to 2% and above. However, recent CPI data are beginning to cool. In your opinion, is Japan gradually crawling back to deflation?
We believe Japan will finally get out of deflation in the coming years. The rise in inflation post-COVID was boosted by cost increases, so it was more supply-side effect than demand. However, what we will likely see going forward is a recovery of consumer demand. The wage growth is projected to be sustainable, and it should increase household income and ultimately boost purchasing power. So if we look at the historical relation similar to other countries, the wage growth drove inflation in Japan too. So what we will focus on is if wage growth will outpace the CPI, leading to the positive real wage growth. In the future, the improving real wage growth should drive the volume of consumption, not only the consumer prices. It will likely filter through the consumption market that accounts for more than 50% of GDP.
The Japan stock market, especially Nikkei 225, is heavily influenced by exporters and the movement of Japanese yen, and some extent of spillover effect from Wall Street overnight performance. How much influence does the domestic sentiment and consumption have on the local stock market?
Yes, and it is true that many large cap stocks in the Nikkei index are the global companies. These companies are impacted by overseas economies as well as currencies. In the meantime, domestic demand-oriented companies are more stable. So that's why we often see the headline on the daily volatility focused on the global companies. However, the more important development is that domestic demand-oriented companies have been recovering. For example, the best performer since the beginning of the rally in March 2023 is insurance industry, which rose by more than 100%. The banking index also increased by 80%. And even the retail industry outperformed the export-oriented companies such as electronic and automobile. So in short, short-term volatility mainly comes from the overseas factors, but a sustainable recovery of domestic demand is expected to drive the economy over the medium term.
Although some progress has been made to boost salary, notably, Japan's largest labor union group is only consists roughly 15% of the total workforce and 5.6% against the total population. Is this material enough to boost the domestic consumption?
Yes, it is a key leading indicator for national average wage growth. So every spring, the labor unions negotiate with corporate management on pay hikes when a new fiscal year begins in April. And you are right, labor unions account for only the small part of labor, but it is a key leading indicator for wage growth because many companies refer to the spring wage negotiations to determine their pay hikes in that fiscal year. So looking back, we see the spring negotiations led to average wage growth in Japan. The outcome of the spring wage negotiations includes the impact of job promotions. So it is usually higher than national average of wage growth. But these two indicators have been well correlated. That's why investors carefully monitor the spring negotiations. So for the next fiscal year, starting in April 2025, Japanese Trade Union Confederation has announced that it will require more than 5% pay hikes, similar to this current fiscal year. So besides, it will fix 6% for the small and mid-sized companies, even higher pay hikes. So we need to wait for the final outcome of the negotiations until next spring, but we may see the positive development sooner than later as negotiation will start next February.
Finally, Japan's government official as well as Bank of Japan governor has seen major changes in leadership. In your opinion, are the new government policies sufficient to uplift business activities and reflate the economy?
First of all, the key sustainable driver for the market is revival of Japanese economy after lost decades. So economic policy has impact, but mainly just over the shorter term. But having said that, there will likely be some positive outcome if to follow the previous administration's policy, which is to build the virtuous cycle for the economic growth. It aims to boost the household income and it filters through the consumption and ultimately corporate earnings and investments, and then wage growth at the end. So this key direction of the new government is supportive of domestic demand-driven recovery of Japan economy. So all in all, the political events could continue to cause the volatility in the short term, but the key for the revival of Japan is sustainable wage growth. And furthermore, there is still room for the attractive return opportunity in the market because Japan equities have not been re-rated given the current valuations.
Thank you once again to Mr. Yasuo Kono, Senior Product Specialist at Nikko Asset Management Asia Limited, for sharing his insights on Japan's economy and the equity market. We hope this provides valuable guidance for investors considering Japan as part of their investment portfolio, enabling more informed investment decisions. Dear investors, as we are moving towards the end of 2024, and with some of the significant events that happened recently, I hope our experts sharing can help you to make better informed investment decisions. Do engage our relationship manager to review any potential need to rebalance your investment portfolio. See you again in our next Money Chat series.